When it comes to investing in ETFs, dividends are one of the biggest things that people look for. In today's video, we're going to be breaking down and looking in comparison of two of the large ETFs that are income-based orientated, one being the SCHD, which is the Charles Schwab dividend, and of course, JEPI, which is the JP Morgan Equity Premium ETF. Now, there is some slight differences between these, and it is exactly how they make money. When you look at the SCHD, it is derived from dividend income. That is what you get when you look at dividend yield. You are getting actual dividends from companies that are paying dividends. When you look at JEPI or the JP Morgan Equity Premium ETF, it generates income not only from dividends, which isn't the majority holding. The big part of it is by selling calls. That is right. It is a very different strategy with how these two ETFs have a different approach to generating income. But let's go ahead and break these down. Now, of course, my personal preference after doing a lot of research, I look at investing in the SCHD. If you've caught any of my investing videos, there is a very specific reason. Now, it is because this is very traditional dividend orientated funds, where JEPI is really the cover call strategy, which again, not super familiar with. And I always say, do not invest into something that you don't have experience in, or you don't know exactly where it is and how they do it. Now, there's a couple things to remember when we compare the historical performance. This is where, in my opinion, it really makes a big difference. Now, we know JEPI came out in 2020. We know the SCHD launched in 2021. Now, since the launch, JEPI has underperformed the SCHD about 3.25%, which is pretty big annually. So when we're thinking of the last 3 years, annually, and I know 2024 isn't calculated. Now, this does include all dividends. So even when you have the tax difference, because again, there is going to be a difference with how these two generate income, the tax difference would be even larger, creating an even bigger gap between these two when you really put them in comparison. So when you look at the performance over the last 3.5 years, the SCHD has outperformed about 14%, which doesn't make for a very big difference or a very good start when it comes to JEPI. Now, of course, the main difference between these two, like we talked about, are the strategies that they use. Both of the funds are generally invested into large cap US companies, which pay dividends, well diversified, which we don't have to worry about as much of the risk. The SCHD tilts a little bit more towards the dividend stock, where the JEPI does not at all. It is the index calls in its portfolio that they generate income from. In other words, it collects calls options on premiums. Strategy has a lot of pros and cons, which of course, do your research so you know exactly what you're doing. Now, when we think of geography of these, again, being a little bit different in the build itself, the SCHD is majority of it in large cap. So when you think again in the ETF itself, the SCHD has 80% in large cap. We have 17% in mid cap, 4% in small cap. So again, it is a pretty well diversified across all of the, the mid, small, and large cap funds. When you look at JEPI, we have 83% in the large cap, 16% in that mid cap, and 0%. That is right, guys, 0% in the small cap. So JEPI doesn't have anything in those small caps. Now, when we think of sector weights, again, they are very, very similar. There's a few, again, kind of very similar. When you think of financial services, they're about 12 to 14%. Communication, again, 4 to 5%. Most of them are kind of the same. The big thing we see is when you look at JEPI, they're about 5 or 6% higher when it comes to technology. They're also a little bit more invested into basic materials, but not as much in those financial services. And then, of course, JEPI is heavily into utilities, almost 5% in there, where the SCHD has about a 0.3. Now, of course, when you start building in this expense ratio, so the SCHD is a 0.06, where JEPI is a 0.35. That is 6 times more expensive to hold JEPI. We know it does pay the monthly dividends versus holding the SCHD. However, it's only 29 basis points, and strategy differences is the much bigger difference with the expense. So when you look at JEPI, it is managed by 2 individuals with 30 plus years of experience, meaning they're well versed in those options that they're doing. Then, of course, when you look at transaction costs, the amount really to move it in the market, again, kind of negligible with both of those. Now, tax efficiency and capital distributions. This is one of the big things that you have to know. definitely talk to your tax advisor. Depending on how much you have invested, this could make a really big difference. Now, looking ETFs are typically a lot more tax efficient than mutual funds because they're not buying and selling all the time. For a majority of ETFs, they might rebalance once, which we know the SCHD just did not too long ago, but overall, it will make a difference. Now, due to the ability to avoid realized capital gains, like keeping remedies, and again, as expected, neither JEPI nor the SCHD have made capital gain distributions, nor does anyone expect them to be. But JEPI is not very tax efficient. This is the big one, as the premiums received from selling the calls are taxed at ordinary income rates. Again, this is something to think about. So if you're getting that monthly dividend that you'd love for JEPI, let's say you have a significant amount invested, the sells for the calls are going to be taxed at ordinary income. Some investors don't mind receiving the income because, of course, the potential upside of it, but of course, capital gains are appreciated or taxed at a lot less, again, depending on exactly how much is there or how much you earn. And of course, a covered call strategy will lose less money if the market declines, but covered call strategies, including JEPI, have a very large tax drag. On the other hand, the SCHD is about as tax efficient as a dividend ETF can be at all. Now, of course, the other thing with JEPI is the premium cost. So many retail investors focus on the premiums that are received from selling calls. However, investment returns need to be calculated at the net of cost. So again, the calculation on this is a little bit different. If an investor sells a call for $3, buys it back for $1, the return is $2 rather than $3, which of course, if the underlying stocks go up, the investor callback may be at $5, which again, the premiums can really differ or really can change drastically depending on the market conditions. So even though both of them are hugely popular, they do have kind of a different kind of strategy between both of them. And that's why I love doing all of my research and my investigation into these, because I want to make sure that I'm really putting everything into the best portfolio possibly that I can. And again, for me, looking at the SCHD and looking at the JEPI or the JEPI, overall, I go in and I have 25% of my portfolio personally invested in the SCHD. It has been yielding some really good dividend returns, even with the little amount that I have invested. I believe I got about $180, a little north of $180 this quarter, which for me, I kind of break it down that is $60 a month. So what does $60 a month cover when it comes to dividends? Of course, looking at the $60 we get there, that could be a cell phone bill, that could be something. And again, when you think about cash flow and when you think about having the ability to cover your bills in their entirety with your investment portfolio, this is the reason why I want to build it up to a point where the money that you're getting in dividends from these ETFs are going to be kind of crazy when they come in. If you're covering, let's say, $500 to $1,000 a month based on an investment portfolio, and of course, you could reinvest it, you could take it. But overall, I want to get to the point where at retirement, I'll have the ability to actually take income out of this while it still stays and it grows. Just because I'm taking the dividends out doesn't mean the initial contributions and everything we already put in there are not going to grow. All right, guys, let me know in the comments what you guys think. Are you leaning to the SCHD? Are you leaning towards the JEPI? But again, that's going to do it for this video, and I'll catch you in the next one.